Okay, welcome everyone. This is Scott here again with a brand new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And today's video is my next installment of my live option trading series, and so far this has been a very good week. Now, as always, before we fully dive in here, in case this is the first video of mine you've come across, I also want to let you know that you can find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below, so be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. Okay, so taking a look at my portfolio here, you can see I have 5 different positions on right now. 4 of them are short strangles, and 1 of them is a naked call position, specifically a short naked call. And so all of these trades I did put on this past week, although I was not able to record every single one of them. But with that said, I am going to stop here and play a few clips that I did record that will show you the trades I put on in AMD, Beyond Meat, and Royal Caribbean. My other 2 positions on Gamestop and Uber, I'll walk you through after those clips are done playing. So let's get started. Okay, today is Tuesday, August 3rd, and what I have pulled up here is AMD. So this is basically Intel's main competitor. They're also a chip manufacturer. And as you can see of late, this stock has had 1, 2, 3, 4, 5 pretty massive up days in a row. I'll zoom in here. I mean, just take a look at all of this. And it appears that all this bullish euphoria has come from a very good earnings announcement. So it looks like their expected earnings per share was 48 cents, but in reality it came out to be 63 cents per share. So they beat expectations pretty handily, but at least to my eyes, it doesn't seem like they blew expectations out of the water, but still for some reason, this stock has still experienced 5 massive up days in a row. Now, usually when stocks rally, you will oftentimes see implied volatility contract. So down here is the chart of implied volatility for AMD over the past year. However, you can see that the implied volatility is actually expanding, right? I'll try and expand this chart up a bit more so it's easier to see. There we go. So very clearly you can see we have a spike in implied volatility as a result of this massive push higher. So again, typically when stocks do go up, you will oftentimes see implied volatility contract. But in cases like this, where the stock is basically just exploding to the upside, you will actually see implied volatility expand along with it. So you can look in the past at stocks like GameStop or Virgin Galactic, AMC, etc. For each of those stocks, when they exploded upward in price, along with that, you saw an explosion in the implied volatility as well. Right, real quick as an example, let's go to AMC. So right here, during this massive short squeeze, look what happened to the implied volatility. It exploded along with the stock price. So I just wanted to make this point very briefly just to emphasize the fact that implied volatility does not always go down when stocks go up. So let's come back to AMD now. And so for this case, what I'm thinking, let's come over to the trade tab. I was considering either a bearish skewed strangle or just outright selling naked call options. Right, this is just my style of trading. I typically like to get on the opposite side of what the masses or what the herd is doing. So the herd right now is buying this stock up and in massive quantities 5 days in a row. So as a result, I'm going to fade this move, get on the other side, and probably just sell some naked call options. So with that in mind, let's come back here. I'm considering selling just one of these 120 strike call options here for around 440 bucks in credit. Now I am going to manage this position very, very aggressively if it does go against me. So if at some point later today, although I doubt it, or perhaps tomorrow or sometime this week, if AMD just keeps going higher, and if it breaches 120 bucks per share, I will very likely buy 100 shares of the stock or very close to that number and basically convert this naked call option into a covered call option. So finally, let's go ahead and click on the bid price here. That brings up the sell order. So again, we're going to do one contract, and the mid price for this call option is 445 bucks in credit. And then we'll go to confirm and send and take a look at the buying power effect on this position. So it's going to require 1,600 bucks. That's totally fine. And also you will now notice that I'm using a paper trading account for these new positions. And if you haven't seen my previous video where I explained all about paper trading and the reason why I'm switching over to a paper trading account for the next few months, I highly recommend you watch that video, and I'll post a card above linking to it. But yes, for the next few months, I'm pretty much going to be exclusively paper trading because I am in the middle of doing a lot of testing and experimentation with my strategy. And once I iron out the details a lot more, then I'll switch back to real money. But otherwise, as you can see here with the thinkorswim platform, paper trading is pretty much just like real trading. Everything is exactly as it would be with real money, right? Real-time data, real-time trades. Everything is the same, except you don't have that pressure of losing real money if you are either a brand new beginner or if you're like me and you're very much in an experimental phase with your trading. And so now after having said that, I did just see the price of this call option went up. So let's actually go back and I'll readjust the price for this option. I can now sell it for around 480. That's awesome. So once again, we'll go to confirm and send. Buying power is basically the same. Go to send, see what happens. Just got filled at 480. Awesome. And then lastly, we'll set up the buying order to buy this option back if I am correct on this trade. So I want to buy it back at half price. So half of 480 is 240. We'll make it a GTC order, confirm and send, all done. And next up, let's come over here back to the charts and we'll go to RCL. This is Royal Caribbean Group, and they are announcing earnings tomorrow morning before the market opens. So this appears to be a very textbook earnings trade. Down here with the implied volatility again, we can see there is a nice spike right up to this earnings announcement, which is often what happens. There's a lot of uncertainty around how companies like this, especially, companies in the travel or service industries, how have they been doing given the COVID pandemic and all that. So as a result, that's why we're definitely seeing a pretty nice spike in implied volatility. And for this one, I'm going to keep it pretty standard. I'm going to sell a delta neutral strangle. So I'll come back to the trade tab here. Again, I'm in the September expiration cycle, just like with the AMD trade I just made. And also up top, we can see the 1 day expected move for RCL is either up or down by just under $3. So once those earnings figures become public tomorrow morning, the expected move for Royal Caribbean is to either rally all the way to just under $76 per share or drop down to just above $69.50 per share. So that's why for the put option, I'm going to sell the 65 strike and push my strike a bit further away from the expected move on the downside. And then for the upside, I'm going to sell the 85 strike call option. And so as you can see, the delta on this call option is 23 and the delta on this put option is 26. So pretty much the same delta on both contracts, making this a delta neutral strangle. I don't care whether RCL goes up or down. I'm basically just trying to capture the crush in implied volatility that will very likely happen once those earnings figures come out. Right? Again, and I mentioned this before in my other videos, for an earnings announcement like this or an earnings trade, you oftentimes see a buildup of implied volatility prior to the earnings announcement. And then once those figures become public, you often see a crush in implied volatility thereafter. Or in other words, what that translates to in regards to the options on this stock is you will either see the prices of those options get bid up, become more expensive as that earnings announcement gets closer, or at the very least, you might see those option prices just stagnate and not really move anywhere because again, even though implied volatility is expanding, which does have the effect of increasing option prices, you still have things like time decay which can offset that. So basically, if implied volatility just explodes prior to earnings, then yes, you will likely see the prices of those options increase as well. But if it's a more gradual increase in implied volatility, then chances are the time decay on those options will offset that increase in implied volatility, which is why I said at the very least, you will typically see the prices of those options just remain stable, not moving around by too much. But then once those figures do come out, you will almost always see a huge crush in implied volatility thereafter, and that will bring the prices of those options down along with it. So ultimately, that's why I like to sell options when the prices are high and then buy them back when the prices drop and make the difference as a profit. So with that said, let's come back to the trade tab here and we'll make this trade official. So I'll click on the 85 strike call option, go to sell and then strangle. Going to sell the 85 strike call and then also the 65 strike put option right there. And I'm going to do this for around $440 in credit. Very nice. So then we'll go to confirm and send, take a look at the buying power effect, only $730. Very nice. And then we'll go to send. And there we go, just got filled at 440 exactly. Awesome. So finally, last step here, just like with the AMD trade, I'm going to set up my buying order to buy these contracts back if I am correct and profitable on this position. So once again, 85 strike call and then the 65 strike put option there. Buy them back for half price, so that'd be 220. There we go. Make it a GTC order, confirm and send, all done. So those are the two trades I'm going to make today, and we'll see how things play out over the next few days and weeks and how I'm going to manage these trades if at some point I do get into a bit of trouble. All right, today is Thursday, August 5th, and the stock I'm looking at here is Beyond Meat, and this is going to be another pretty textbook earnings trade. Right, so this company is announcing their quarterly earnings once the market closes today, which is in about an hour from now. And amongst many other companies that are announcing earnings today as well, I chose this one specifically because it does have the best implied volatility. So for example, coming down here, looking at the implied volatility chart over the past 1 year, you can see we've had a very nice buildup of implied volatility, a nice buildup of uncertainty leading up to this earnings announcement. And this translates to an IV rank of 43%. That's very good. And also an IV percentile of 67%. That's very, very good. And overall, the implied volatility for Beyond Meat stock is just under 70%, which is definitely on the higher end for most individual stocks. But of course, if you look at this chart here, you can tell this is a very volatile stock. So of course, as a result of all this volatility, if we come over to the trade tab, you can see the options on this stock are very highly priced. So right now I'm looking at the September expiration cycle. These options expire in 43 days from today. And because this is an earnings trade, I'm just trying to capture that crush and implied volatility once those earnings figures become public. That's why I'm putting on here a delta neutral strangle. So the delta on the call option I'm going to sell here, which is the 150 strike call option, has a delta of 19. And then along with this, I'm also going to sell the 105 strike put option. The delta here is 20, basically the same thing. And the expected move for this stock once those figures come out is up or down by just over $10. So ideally come tomorrow, I want the stock to be under $132 per share or above $112 per share. But just in case the stock actually moves beyond the expected amount, that's why I chose my strikes to also be beyond the expected move. Right, so Beyond Meat can actually drop a full $17 before it hits my put strike, and I can also rally by about $28 before it tests my call strike. Now, sometimes also I do like to come over to Yahoo Finance and just take a look to see what the expectations are for the actual earnings figure, specifically their earnings per share. So you can see here for this quarter, the average estimate for Beyond Meat is negative 23 cents per share. Obviously, they're not a profitable company yet. And notice you can see 1 year ago, for the same quarterly earnings announcement, they were at negative 2 cents per share. So they're actually projected to do worse this year than last year. Now, what does that mean for what the stock will do once those figures come out? I have no idea. I've seen stocks that totally fall short of their expectations and the stock rallies the next day. Or I've also seen stocks beat expectations by a huge amount and the stock plummets the next day. That being said, I still like to check what the expectations are just to make sure that there are no surprises. Like for example, if 1 year ago their earnings per share were minus 2 cents per share, and then this year they were projected to do maybe positive $2 per share, something wildly different, that might influence me to change my strategy. But because in this case, because Beyond Meat is basically projected to do a bit worse than last year, and of course we'll see what actually happens once those figures come out, I don't see anything here that is alarming. So with that said, I'm going to keep my strategy as is, a delta neutral strangle. So finally, let's go ahead and set up this order. So go to sell and strangle. We're going to do just one contract of the 150 strike call option and then one contract of the 105 strike put option. And I'll come down to 570 just so I can hopefully get filled immediately. So $570 is the total credit I'm looking to collect on this strangle. That's definitely a very nice amount for a $120-ish stock. So we'll go to confirm and send. Check the buying power, $1,200. That's totally fine. And we'll go to send. And no fills yet. So let's come back to the monitor tab and take a look. And so you can see my Beyond Meat order down here. Let's go ahead and cancel and replace. I'll come down a bit more in price. Actually, nope, no need. Just got filled at 574. So that's great. And no need to place this order again. So last step is to set up the buying order. Go to buy, strangle. So this is the order that will buy back these contracts if I'm correct on this position, let's say tomorrow or over the next few days. Once those figures come out, maybe Beyond Meat doesn't move around too much, implied volatility collapses, and so does the prices of these contracts, and that will therefore allow me to buy them back for a much cheaper price and book some profits. So down here, we're going to buy back the same call option, buy back the same put option, and we'll do so for half price. So half of 574 is 287. Make it a GTC order, confirm and send, all done. Okay, welcome back. I hope you enjoyed those few clips there. And now let's walk through my current positions and we can see where everything is at today. So right now, AMD is the only position I have on currently that is giving me somewhat of a hard time. Although as you can see, I'm only down on this position by about $130, not a huge deal. So I'll come back to the charts and I already have AMD pulled up here. So again, for this trade, I am short the 120 strike call option, which is right around here at this level. And I do apologize for all the stuff that's on my charts right now. I do have a lot of orders in place to hedge this position if things go wrong. And so part of the reason why I am down a bit on this position is because I did have to hedge this one specifically on this day, which was on August 4th. Because as you can see, AMD spiked all the way to $122.49. So it did breach my call strike and I had to buy some shares as a hedge, then sell them for a small loss, etc. But now perhaps we are seeing a downturn in the stock, and over the next few days, if AMD does continue to fall lower and lower and lower, perhaps down to the 20-period moving average, then this will be a very profitable position. So at this point, there is nothing more I need to do for this position. As long as the stock is below my strike price, I'm totally fine. So we'll wait and see what happens over the next few days and weeks. Let's come back. Next, we have my Beyond Meat short strangle, which as you saw in one of those clips, this was an earnings trade that I placed yesterday on August 5th. And so far, this is a very, very nice trade. Let's come to the charts real quick and we'll see why. BYND. So the earnings figures came out and let's see what they were. I didn't really check. So they basically fell short of expectations by a few cents, not a big deal. And right now the stock is up by just over 70 cents. So this stock has basically moved nowhere. And keep in mind, the expected move was either up or down by a full $10. So this is well within the expected move. And also implied volatility got absolutely crushed, which you can see down here. So the implied volatility fell from about 70% down to right now at around 55%. That's a very nice drop. And so this here was mostly what I was banking on for this position, right? Oftentimes when earnings are just around the corner, you will typically see a buildup of implied volatility. And then once those figures become public, boom, you will oftentimes see a crush of implied volatility thereafter. So basically what that means is I can sell options up here when they have high prices and then buy them back when they're much cheaper and make the difference as a profit. Now, as of right now, Beyond Meat has not reached my profit target. If I scroll down a bit here, you can see my Beyond Meat position, or my closing order rather, is right here. So I'm aiming to buy this strangle back for a debit of $287, and currently it's trading for $345. So I still may take this position off today, given that it came in so quickly, just over the course of one night. But we'll see. I would still like to squeeze out maybe an extra $50 or so out of this position. So I'm going to hold on to it for a little bit longer at least. Next up, we have my Gamestop Strangle, which I did not show in my clips this week. I put this position on Monday. So let's come to the charts real quick here and go to GME. So yes, this is definitely a little bit of a risky trade given what GameStop has done in the past. But as you can see, as of late, this stock has pretty much just gone down a little bit every single day in very small increments. Now, of course, anything can happen. Perhaps tomorrow this stock could be up by 20% for some dumb reason. But it definitely seems as of right now, the euphoria around GameStop and other meme stocks has pretty much subsided for the time being. So at the time I put this position on, it was a slightly bearish skewed strangle. Let's come to the option chain real quick. I am in the August expiration cycle, which does expire in 14 days. So this is meant to be a bit of a shorter term trade than my other positions, which are all in the September expiration cycle. But as you can see right now, I am short the 185 strike call option and the 130 strike put option. And with the delta of the put being 19, which is the exact same as the delta on the call option, this is currently a perfectly delta neutral strangle. I am totally directionless in this position. All I want over the next 14 days is for GameStop to be somewhere within this price range, above 130 and below 185, and that's really it. So this one here, unlike my earnings trades, where with those trades I'm mostly banking on a contraction of implied volatility, you can see with GameStop, there really is not much implied volatility, at least relative to the past year for GameStop, right? The IV rank is only at 6%, IV percentile is at 14%. Both of these were definitely a bit higher on Monday, but overall, I do not expect to see that much contraction of implied volatility. That being said, the implied volatility for GameStop just in general right now is at 125%, which you can see right down here. So even though relatively speaking over the past year, the IV for GameStop right now is pretty low, right? Because just a few months ago, the implied volatility was at 200%, or back here, it was all the way above 300%, etc. But still, for any stock to have an implied volatility of 125%, that's still very, very high, especially given the fact that right now and over the past few weeks, GameStop has not been volatile at all. So again, with this position, I'm just basically playing the odds. I just want GameStop to remain within that price range. And so far so good, because on this position, I'm up by about 200 bucks, a little bit more. Next up, we have RCL, or Royal Caribbean. So let's come back to the charts and go to RCL. So just like Beyond Meat, this also was an earnings trade, and so far so good. You can see leading up to that earnings announcement, which was right here on August 4th, there was a nice buildup of implied volatility, and now it's starting to come down. I was expecting to see a bigger crush in implied volatility the day after earnings came out, but so far at least it's been a lot more gradual, and that's okay. And the stock definitely has pushed quite a bit higher since the figures came out, which is definitely a bit puzzling, because if you come down here, you can see they missed their earnings expectations by quite a bit. And in fact, they were actually negative by $5.06 per share. Obviously, right now, people are not going on cruises, and yet somehow the stock was up by 7 or 8% just yesterday. But currently, I have not had to make any adjustments to this position, so come to the trade tab. I'm in the September expiration cycle for this one, and so far both of my options are still out of the money, so again, nothing to do here. But as you'll notice, because of that big push higher that happened yesterday, the delta on my call option is now 29. The delta on my put is at 17. So this is now a pretty bearish skewed strangle. I would like to see the stock price come down a bit more, and so far today, that's definitely happening. But if it can come down an additional $2 or $3, that would be ideal. Coming back, and the last one we have is my Uber strangle, which is also something I was not able to record, and this was also an earnings trade. So a lot of earnings this week. Let's take a look at the Uber charts. So for this one, I put on a delta neutral strangle at the time. I sold the 47.5 strike call option, which is somewhere around here. So definitely still a little bit of a ways above where the stock is right now at $44 per share. And then I also sold the 37.5 strike put option all the way down here. So even though directionally speaking, the stock has moved against me by a little bit more than I would like, because implied volatility got crushed once these earnings figures came out, just like with Beyond Meat, that's why this position is profitable at the moment. So just more proof here that when you can trade implied volatility correctly, that can really be a major advantage in helping you to turn a profit in your option positions. And so with this one here, I am a bit interested to see what happens, or what will happen over the next few days. You can see in the recent past, the stock has seen a few short-term rallies up to about the 20-period moving average, and then an immediate sell-off. So what's happening here? A short-term rally. You can see it got up to and just about touched the 20-period moving average, and now it's backing off. I'll zoom in a bit more so it's easier to see. This is what I'm talking about right here. Came all the way up and just about touched the moving average, and now it's backing off. So perhaps over the next few days, maybe next week, we'll start to see a reversion with the stock moving back down lower. That's what I would like to see anyway. And so with that being said, I think that's going to do it for today's video. There are some more earnings trades next week, so I will likely be active in selling more options around those events, so stay tuned for that. But anyways, I hope you enjoyed the video, and definitely let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.